All right, let's talk about something that every single investor goes through. It's that sinking feeling. You did all the work, you believed in a company, and then you just have to sit there and watch the stock price go down day after day. It's honestly painful. And it always leads to the big question, when do you finally call it quits? I mean, this is the question, right? It's what keeps you up at night. You poured hours into this. You felt like you knew the business inside and out. You were so sure. So, what gives? Is this just a little market turbulence, a dip you can ride out, or is it a warning sign of something much, much worse? Let's figure out how you can tell the difference. So, the first, and I mean the biggest hurdle we have to get over has nothing to do with the numbers on a screen. Nope, it's all in our heads. We're talking about a huge psychological trap, and it's all about our ego and our emotions. Think about it. When you spend weeks, maybe months, reading every report and building your case for a stock, it becomes more than just an investment. You kind of develop a sense of ownership, you know? Your decision becomes a part of your identity as a smart investor. So when the market starts telling you you're wrong, it doesn't just feel like you're losing money. It feels like a personal attack. And you know what? There's a name for this feeling. It's called the sunk cost fallacy. It's this powerful, sneaky bias that tricks us into staying on a losing path just because of everything we've already put into it. It's that little voice in your head that says, ugh, I can't sell now. I've already lost so much. And let me tell you, that is one of the most dangerous thoughts you can have in investing. To really make this hit home, let's just forget about the stock market for a second. Let's think about it like you're flipping a house, a real fixer-upper. This analogy is just perfect for showing the exact mental trap we're trying to avoid. Just look at the two ways of thinking here. The speculator, they're completely trapped by the past. All they can see is the 300 grand they've already sunk into the project. But the real investor, they're laser focused on the future. They get that the money they spent is gone. It's a sunk cost. The only question that matters now is, does spending the next dollar actually make any financial sense based on what this house will be worth in the future? And that's the absolute bottom line here. The price you paid for a stock, it's ancient history. It has zero, and I mean zero, to do with whether that company is going to succeed or fail tomorrow. The only thing that matters is where it's going. Okay, so let's say we've managed to check our ego at the door. We're ready to be rational. Now we hit the next huge challenge. Is my company just in a temporary slump, or is this a permanent lights-out terminal decline? Getting this right is absolutely everything. Now, you might be looking at your company and thinking, but hey, it's still profitable. They're still making money. And you could be right. But here's the tricky part. Profitability can be a lagging indicator. It tells you about the past, not the future. Just think about the newspaper industry back in the early 2000s. They were posting record profits while the internet was literally dismantling their entire business model right under their noses. So how in the world do you tell the difference? Well, a cyclical dip is like a bad season for a good company. Maybe there's a recession, something that affects everyone for a while, but things will bounce back. Terminal decline, though, that's something else entirely. That's when the world itself changes, and it just doesn't really need what your company sells anymore. And if that's the case, the real value of your stock might actually be on its way to zero. So how can we spot this terminal decline before it's way too late? Well, just like a car, a company's financial statements have their own check engine lights. You just have to know what you're looking for. Here are 3 huge ones you've got to watch out for. First, inventory bloat. If stuff is piling up in warehouses way faster than it's flying off the shelves, that's a massive red flag that demand is drying up. Second, a drop in the interest coverage ratio. This basically tells you that debt payments are eating up more and more of the company's profits, putting a serious squeeze on its health. And third, a spike in accounts receivable. This can be a sign of some sketchy accounting, like the company's booking sales on paper just to hit its numbers, even when the cash isn't actually coming in. All right, so even if all those check engine lights are flashing, making that final call to sell can be just agonizing. So now we're going to talk about the ultimate mental tool that pro investors use to slice right through all that emotional noise and get crystal clear. Seriously, I want you to stop and really think about this question. Forget what you paid for it, forget how long you've held it. If you're starting totally fresh today with a briefcase full of cash, is this stock at this price the absolute best place you could put that money? The process is so simple, but wow, is it powerful. Just picture it. Your account is 100% cash. You look at that losing stock you've been stressing over, and you have to ask yourself, with all the thousands of opportunities out there in the market, is this really where I want to put my capital right now? If the answer is anything less than a resounding yes, then you have your decision. This right here is the whole game changer. Every single morning you wake up and you choose not to sell that stock, you are actively making a decision to buy it all over again at its current price. If you wouldn't get your wallet out and buy it today, why on earth are you letting it take up precious real estate in your portfolio? Let's make this super concrete with a real-world story that just perfectly illustrates this whole idea. It's a tale of holding on to the past versus investing in the future, and it features two of the biggest names in tech. So between 2020 and 2024, tons of investors were clinging to Intel stock. Why? Because it looked cheap on paper, and hey, it's Intel, a legend. But they were looking in the rearview mirror. The reality was, Intel had fallen way behind technologically. At the same time, you had NVIDIA, which looked super expensive, but it was capturing the future. It was capturing the entire AI revolution. Holding Intel because you thought it just has to go back up was a classic sunk cost mistake. The company's competitive edge was gone. Okay, let's bring all this home. It's time to completely reframe how we think about selling. We need to stop seeing it as a failure and start seeing it for what it is, a strategic, disciplined, and really powerful move for any successful investor. I mean, listen, if the greatest investor of all time, Warren Buffett, sells at a loss, then it's okay for us to do it too. In 2020, he famously dumped all of his airline stocks. Why? Not because he made a mistake, but because the world had fundamentally changed. His original reason for buying them just wasn't true anymore. He wasn't admitting failure. He was protecting his capital so he could put it to work in better opportunities. That is how the pros think. So this all boils down to a super simple framework you can use for any stock you own. Just ask yourself these 4 questions. Number 1, the core. Is their product still the best, or are people switching to something else? 2, the moat. Does the company still have that secret sauce, or are its profit margins getting squeezed? 3, the math. Is actual cash hitting the bank, or is it all just paper profits? And finally, number 4, the future. Would I buy this today with fresh cash? If you hear yourself saying, I'm just holding till I break even, that's your biggest warning signal of all. It's time to act. So I'm going to leave you with this one question. Tonight, or right now, take a hard, honest look at your portfolio. Put the emotions, put your ego, just put it all aside for a minute. Which one of your stocks would fail that empty briefcase test? Answering that question honestly might be the most profitable thing you do all year. Thanks for joining.